I think firstly, it's important to take a step back and say, okay, where are the trade balances, right? And we know that in 2025, the trade in goods deficit for the United States hit a historic high. So we're still operating by that famous theory of competitive advantage. And there are some economies that are producing things in the goods space that the US needs at a faster rate and potentially at an even higher quality rate that it can produce itself in a short amount of time. So, of course, one of those we know is chip fab coming from Taiwan. We've seen some of the winners from all of this trade tensions, regardless, happens to be some of the high tech, high income Asian exporters. And we've seen that with one of the bright spots for 2026 that we highlight is just the export capacity for some of these Asian economies. I think looking to the US, obviously, we've seen the news over the weekend. Many have focused on Brazil and China getting away slightly better, obviously, because they're at a more elevated rate than 15%. Something, Sherry, that I'm also going to be looking for that perhaps the US doesn't always think about is, we still get almost half of our oil exports come from abroad, right? So our daily final demand comes from abroad. 70% of that comes from Canada and Mexico, which are still held under USMCA. So if there are further disruptions to USMCA, I know that's going to upset many economies, and particularly even manufacturing countries like Japan, who have a strong presence manufacturing in the US that still rely on goods coming from Canada and Mexico as well.
Yeah, Alexis, that's the heavy sour stuff that the Gulf refineries are tooled up to best process. Understood. Alexis, I want to try and spin it forward. I know we've been talking about refunds, et cetera, but spin it forward to what the president is trying to do now. He's not taking this lying down, the SCOTUS decision, so he's trying to continue prosecuting his tariff war through Section 122 of the Trade Act, which is legal, right? Which is legal, conditional upon meeting the requirement that the United States is in a balance of payments crisis. Is it? Because on the surface, when I look at it, trade deficit, absolutely, right? But on capital, I mean, the U.S. is running such a large surplus, it's not even funny.
Capital and services, Martin, that's something that we've talked about over the last year and a half, is the extent to which the U.S. has run this generous surplus in services. So we think about that, the revenue of the tech portion of the S&P 500 that's earned abroad is significant. So the US is importing chips in the goods sense, but it's also exporting AI in the services sense. The capital is another side of things, and something also that we would like to highlight is just the fiscal deficit, right? There's been a laser sharp focus on the trade deficit, but what is happening on the fiscal landscape as well? And so we've seen some of the promise of that with the tariffs to be able to redress balances. But the simple fact of the matter is that the United States, just like Japan, continues to be able to have to dedicate its expenditure in the government side of things to interest rate payments. And so that's something I think that investors will hold pause on allocating to the U.S. over the long horizon.
We don't know there's really no clarity in terms of refunds, but, the risk is that the government is going to be left with a pretty large shortfall in terms of revenues from tariffs that were supposed to have been or have already been collected, right? So what is the offset to that? I cannot imagine that with midterms coming up in November, an election year, that taxes are going up. That's just not that's a non-starter. So what else conceivably could be in place to offset the loss in tax revenue?
Well, also we have to think about the type of expenditure with the One Big Beautiful Bill coming into effect as well, adding to that. I think, Martin, it's safe to say that the president loves tariffs, and he has highlighted to us that it's the most beautiful word in the English language. And he's likely to continue to find ways to be able to extract revenue on the tariff side. So I think that we can safely bet that he's going to definitely try different manners in which to pursue some kind of a policy.
I agree wholeheartedly that, yes, President Trump loves the tariffs, and I'm sure that he believes it's a beautiful word. But how do you view the impact of all this? Is it disinflationary or inflationary? Because he wouldn't like it so much if he understands it to be inflationary. So far, all the tariffs that were announced since April 2nd of last year haven't been really inflationary on their own.
Sherry, it's a great question that you highlight, and I think it's important to be able to distinguish between inflation and price levels. And so one of the reasons that we haven't seen this round of tariffs result in higher inflation in the US is that we have bigger disinflationary forces that are pushing down that price basket. So the weighting of PCE and also CPI is towards shelter and the cost of shelter. So in CPI, in the US, that's 44% of that is weighted towards shelter. And we've just seen, Schiller come down. You've had 29 consecutive months of rent declines in the United States. The other component of that, of course, is energy prices. And so with oil having hovered close to $58, $60 a barrel last year, that has also contributed to a disinflationary environment. Nevertheless, what we have seen is that we're seeing companies start to pass on the tariffs to the consumer, particularly with Jan 1, as we've actually reset. You're seeing this happen. New York Fed data shows this, that you're seeing this happen in sectors that are very tariff exposed, such as new automobiles, furniture, electronics. So you are starting to see that passed on. There's something else worth pointing out, Sherry, that's not really a part of the debate so much as the fact that demand in the US is very, very strong. And you're seeing that happen across income brackets. So if the consumer is still spending, there's nothing that prevents companies from passing on and taking price and passing this on to the consumer. There was a little bit of concern, of course, as we saw in reflection upon Liberation Day last year, but I think you're going to start to see this actually creep up. The other thing that we have is what happens in Iran, and would some kind of sustained, prolonged congestion in the Straits of Hormuz remove that disinflationary impact on the price of oil?
And spike the price of the black stuff. I hear you. So for as a House, I mean, PWC, what's your base case? I mean, if the president is good at his word, and this is going to be, should there be a military action or a strike, this isn't going to be days, it's going to be weeks, if not months, right? How high could oil go?
So, Martin, we've talked about this in the past, that for every 100,000 barrels of oil you take off the market per day, the price can move by $1.10 differential. And so if you see that 20 million barrels, so roughly a fifth of daily final oil demand, comes through the Straits of Hormuz every day, plus about a fifth of global LNG trade, you could actually see how prices could go to $100 a barrel very, very quickly, and that some markets would be more impacted than others. Let's take India, for example. So the president has recently met with Modi and renewed diplomatic pressure, something the Biden administration did as well, for India to curtail its purchases of Russian crude. Now, where they've made up for those lost Russian barrels is from Saudi Arabia. So if all of a sudden you had choke point in the Straits of Hormuz and oil couldn't get around through the east side of Saudi Arabia, that could present a problem. And that could present a problem, of course, to central bankers who've been dealing with quite benign inflationary environment, particularly in India as a price maker or price taker.